Hey everybody, welcome to another episode of Trading. Today, I'm gonna go over the stochastic indicator, and there are some theories I think you guys might have about the stochastic indicator that might not actually be true, and I wanna clear them up. So let's start with that. When you're looking at the stochastic indicator, you might think that this indicator is pulling price and volume in order to create these moves up and down. But that is actually not at all the case. I want to quote something. This is from George Lane. This is an indicator he built within the 1950s, right around that time. This is what George Lane said, that the stochastic indicator does not follow price or volume or anything similar. He indicates that the oscillator follows the speed and momentum of price. But take a look at this, and I'm gonna get into the technical side of this of how to use the indicator. But check this out. Lane also reveals in interviews that, as a rule, the momentum or speed of the price of a stock, Forex crypto, changes before the price itself. So if he knows that the momentum and the speed changes, then that is part of the reason why he coded this indicator, because it works off of speed and momentum, not price and volume, which is just kind of something I don't know if a lot of people realize, because a lot of new traders think that the price going down, the volume pushing the candles up, or volume dropping off, maybe creating lesser candles, smaller candles, or maybe dropping it off. That's actually not what the stochastic uses. It uses speed and momentum, and that's directly from George Lane, who created the stochastic indicator in the 1950s. So let's get over to actually what you want to hear in this video, and that is, how do we use this to trade and kind of find trade setups? So let's take a look at this. We have three parts of this that I want to point out. We have the blue line, which is referred to as the K line, and we have the D line, which is referred to as the orange line. So let me open this for you and you can see that real quick. Under style, you can see K is blue and D is orange. This is what is referred to as a range bound indicator. So the stochastic lines will never go above 100 and they will never go below 0 on the chart. This is helpful to tell traders if we are in an overbought or oversold territory. When the indicator has stochastic lines that are above this purple line, that means we are in an overbought area. When the blue and orange lines are below this line, that means we are in an oversold area. So how do we use this to actually trade? Well, I'm gonna show you guys two ways: crossovers, and probably my favorite way of using this indicator to trade by far is divergence. And there's a perfect setup on the chart. If you know what divergence is, see if you can find it before I point it out, okay? So let's take a look at it right here. We see that the blue line is crossing above the orange line right about here. And let me get this tool out here again because it'll be easy for you to see. Right around this area, let's point it out. Right around here, what do we see happening with the price? The price actually starts to move up. And then right here we see, make this a little bit bigger for you guys, that the blue line crosses down below the orange line. And we see, corresponding, that the price actually did move down a little bit, which was kind of interesting. It didn't last too long before, again, that we see the blue line heading above the orange line here, and we start moving back up. So it is an indicator that people use to kind of get in trades for long and short positions, or to kind of give them a sense of where the market might be heading. And that's a way that a lot of traders use it. But I want to transition real quick to show you guys how to use with divergence, which I personally think divergence is possibly the best way, in my opinion. I don't want to say like the best way, but it is probably more of a advanced way of trading, and it's something I really prefer myself. So take a look at this. What you're gonna do is you're gonna find a low of the stochastic, and I'm gonna pick a low point here, and I'm gonna use a ray tool so I can show this to you guys. I'm gonna pick this low right here. I'm gonna go down, I'm gonna come up until I see another low. Bingo, right there. So what I see on this point right here is that this low here is just a little bit lower than this low over here, okay? But what is happening with the price during this duration of time? If we come over here, we can actually see that this low right here is creating another low, a lower low. So down here, the stochastic is saying that we're moving upwards, but the price is saying that we're actually moving downwards. So what can happen here a lot of times is that the price will then start trending upwards after you see this. This is what is called divergence on the stochastic indicator. And it's a very powerful way to trade. This is basically telling me, in my mind, when I'm looking at this, the pressure of the market is wanting to go upwards, but the price keeps heading downwards. Most of the time, you're going to see that the indicator is going to win out on this and it's going to push the price up instead of keep going down. So what I want you guys to do is practice this on your chart. Open up a blank screen, whatever you want, crypto, stock, or forex. Pick your favorite pair. Try this out. Put the stochastic indicator on your chart. Try to find divergence, and I'll go over divergence more in other videos because we're going to pull the tops as well. But for this point, go to EURUSD, try to find divergence, see if you can trade with it with a paper trading account on TradingView before you go live. And I think this will really help your confidence when you trade because this is a pretty good signal to tell you when the trend might be reversing. Hope you guys have a good one. I'll see you in the next video. Thank you for all the support, and I'll see you guys later. Bye-bye.